You're made as a host,
Yes, sir.
right?
Shall I share, sir?
Yeah. Okay.
ஒரே ஒரு நிமிஷம் லைவ் போயிட்டு இருக்கு. உனக்கு அது ஃபினிஷ் ஆன உங்களுக்கு ஹோஸ்டா மாத்திரேன் சார். ஒரே நிமிஷம்.
Yes, sir. Yes, sir. You find
Yes.
out from that. You can display, right? Awesome. Yeah.
நான் இப்போ ஹோஸ்டா மாத்திரேன் சார்.
Yes.
You are host now.
You're a host.
இது வந்துருக்கு, you are host now sir.
Yeah.
Yeah.
We are the host.
Here everything pakka sir.
Yes.
Yes sir.
Okay.
Dear students, very good evening to all of you. Today our Bala sir is there to explain about AFM class for IBS. So it's a second session, final session for Bala sir. Over to Mr. Bala sir. Please sir. Tamil புத்தாண்டு வணக்கங்கள் sir.
Yes. And very happy Tamil New Year. I hope you become a qualified CA, by July 2026. Okay. Now let me go ahead and take on question number 8, case study number 8. We are going to start with case study number 8. In that, first I will take up the descriptive question. Is that fine? Chirag, can we have that question first?
Yes, sir.
Descriptive?
Descriptive question.
Question 8, right?
Yes, sir.
So, case study number 8. In that, there are 2 questions, one MCQ, one descriptive. Now, first we're going to take up the descriptive question. Question number 8, right?
Yes, sir.
Yeah, read the question, Chirag.
STPL seeks your advice on the option to be chosen to hedge the foreign exchange risk.
Okay. That is the question, right?
Yes, sir.
Now, to understand this question, let us go through the data that is given in page
90.
90. Now, let us go ahead and take on that data. Then you'll understand what has been asked for, whether to hedge or not. Yes, sir.
The board of directors of STPL have been working on expanding the plant capacity to meet the requirements of the current expansion plan.
Okay.
A set of 10 machines need to be bought for this project.
Mm-hmm.
The gestation period would be 2 years, whereas the machines have to be ordered and imported from USA.
Okay.
After this period, the cash flow will start increasing gradually over 15 years.
15 years, okay.
Overall, the expansion project is expected to generate positive cash flows.
Okay.
For this, STPL will have to settle an import bill for $130,000.
Now it is given that right now the company has to settle an import bill of $130,000.
There are 2 options.
Now there are 2 options available to your company. Yes, sir. Option 1.
Option 1, pay immediately by availing overdraft facility.
Now what are you going to do? You can go ahead and ask the banker to lend money where you want to arrange for an overdraft. And then you want to pay the $130,000 immediately. Yes, sir.
Currently, it has a clean overdraft limit and bank charges 14% per annum for availing the same facility.
Clean OD is nothing but OD without any collateral or without any security to be provided by you people, right? It's only, that is, you can avail this overdraft. And these are generally a working capital loan that is given by the banker. And what is the rate of interest they're going to charge? It is 14%, right? Per annum. Next.
Option 2, pay after 3 months with interest at 7% per annum and cover position in forward market.
That is, you can pay the supplier because you are the importer. You can pay the supplier after 3 months. The only thing you have to pay how much interest?
7%.
It is 7% per
And
annum. So on $130,000. And you have to make the payment after 3 months. Now, because you have a payment after 3 months, what are you going to do? You can take a forward enter into a forward contract. Is that fine? Yes, sir. Now, that is the data given in the question for you to answer this. Now, should the company pay the money today by arranging an overdraft, or should you pay the supplier after 3 months with 7% interest? And because you have a payment in three months' time, you can enter into a forward contract. Now read the rates given. Have you got the spot exchange rate?
Yes, sir. The
read.
exchange rates in the market are as follows. Spot rate rupees by dollar.
Please remember they're given rupees to dollar. Okay. And being an importer, you need to buy dollars for payment. Is that fine? If you are buying dollars, the banker is selling the dollar. So tell me what are the rates given, sir? Spot rate.
82.19 by 82.21.
It is 82.19 hyphen 82.21. Now remember, because you want to buy dollars, that is supposed to be the base currency in the quote, rupee per dollar, and you want to buy dollar, the banker is selling dollar. And the banker will sell dollar at a higher rate, which is what? 80? 82.21. Next. And also they given 3 months. Forward rate. What are the forward rates given?
Rupees by dollar 82.98 by 83.01.
Okay, 83.01 are the rates given. Now let us go ahead and take on the solution to this. And solution for descriptive question 8 is there in page
99.
99. Okay, let us go ahead and take on the solution to that. Yes, sir.
If STPL pays now, it will have to buy US dollar in spot market by availing overdraft facility.
Okay.
Accordingly, the outflow under this option will be particular amount.
Particulars and amount. Now tell me $130,000 in case you want to buy. It will cost you how many rupees? Because you want to buy the dollars for payment, right? So $130,000 into rupees 82 point. Yes, sir. Read 82.21. How much?
Rupees.
And that is the amount of overdraft you will arrange for. So that is the rupee amount you need to purchase or buy 130,000 US dollars. And that is the amount of money you're going to borrow from the banker. And on this, the banker will charge 14% interest for 3 months. We assume that this OD or this loan will be repaid in how many months? In 3 months. So that I can compare this, the cost of this alternative, with where you take a 3 months of forward cover and pay the supplier in 3 months' time. Got it? For that purpose, we assume that this OD will be repaid in 3 months' time. So add interest at 14% on this amount for 3 months into 3 by 12. How much you get?
3,74,056.
Then adding both is the total cost of this alternative. How much? 1 crore?
10,61,356.
That is alternative 1. Then what is the second alternative? Where you pay the supplier later with interest. So just see $130,000, right? And then add interest at what rate? 7%, right? So $130,000 into 7 by 100 into 3 by 12. How much, sir?
$2,275.
In all, you're supposed to pay how much? 132,000. 132,000. $275 in 3 months' time. And you remember, you would have definitely taken a forward cover because you know you have a payment in 3 months' time. And in case you want to buy these dollars in 3 months' time, the forward rate is rupees 83.01, right?
Yes, sir.
Yes, so what is into rupees 83.01?
Rupees 1 crore 9,80,148.
And that is your cost in rupees. Now tell me, now should you go for alternative 1 or 2? Because you're comparing the cost, right? You have to choose the least cost alternative. Now, which is the lower cost alternative? It is the second, right? Where you pay the supplier later in 3 months' time with 7% interest on amount due. Yes, sir. Now read what is given below that.
Advice: since outflow of cash is least in option 2,
Option 2 or alternative 2.
hence it should be opted for.
That's it. It's a very basic sum. In fact, you'll find this question even in your AFM paper. Very popular, whether to make the payment now, lead the payment, or you lag the payment. It's called leading or lagging. Whether you want to make the payment now, or you want to make the payment later. Okay. So that is a question. Now let us go ahead and take on. There is an MCQ, right?
Yes, sir.
It is MCQ number
3.
Number 3. For this, data is there in the MCQ itself to answer this. Now let us go ahead and take on this question. Yes, sir.
Question number 3. To fund the investment of $85 million in SL's 200-acre plantation, STPL plans to raise 30 million through debt with the intention of maintaining certainty in future interest payments. STPL aims to secure a fixed interest rate.
Oh, okay.
STPL can borrow for 1 year of SOFR.
Point to note. It is given that you want to fund an investment of 85 million, right?
Yes, sir.
85 million? Is it rupees or dollars?
So $85 million.
Dollars. That is going to borrow 30 million. That is the money needed for the plantation, right? That is going to borrow out of $85 million. You're going to borrow $30 million debt. Okay. Now you have a choice. You can either go for the fixed rate or the floating rate. Read, sir. $30 million debt. From there you read.
$30 million through debt with the intention of maintaining certainty in future interest payments. STPL aims to secure a fixed interest rate.
That means a company wants to go for a fixed rate of interest.
STPL can borrow for 1 year at a fixed rate of 6% or at a floating rate of 2% above SOFR.
You saw that the company can either go for a fixed rate loan and pay 6% interest on the loan, or go for a floating rate, which is SOFR plus how much? 2%. You know what is SOFR? Nothing but it is, earlier we used to have something called the, people say LIBOR, something called the London Interbank Offer Rate. Now that is replaced after a big issue with the LIBOR, way back in 2011. They said, okay, let us replace the LIBOR. There was a major scandal. They said, let's scrap it. Okay, no more LIBOR. And each country having their own rates. Example, India can have something called the MIBOR, the Mumbai Interbank Offer Rate. And in the US, they have something called secure. Like a prime lending rate plus something. The SOFR is like basic rate plus some extra percentage where the loan is given by a banker to a corporation, to a company, because there is a risk of default. That is why they add some percentage. How much is SOFR plus 2%? Then read further.
Management of STPL decides to enter into a swap arrangement with company TIMA.
Now they have one more company out there, okay, called the TI
MA.
Tima. Okay, that's another company. Yes, sir.
Company Tima also wishes to raise $30 million
Even they wish to raise a $30 million debt.
to take advantage of any fall in interest rates. Tima is interested in borrowing funds at floating rate.
Now they want to borrow money at floating rate of interest.
However, it can only borrow funds at a fixed rate of 7% per annum.
Is what? They can borrow money at fixed rate at what rate? At 7%. Is that fine? Yes, sir.
Or at
Floating rate is SOFR plus
4%.
plus.
Because lower credit rating STPLT.
You guys, the person reading the question, Chirag, another say intermediate student. Okay. The person reading the question over here, and you people, let us assume you guys the STPL, right? You can borrow money at 6% fixed rate. Yes or no?
Yes, sir.
If I borrow money, what is the fixed rate applicable to me? 7%. That means what? That is a 1% difference. From your standpoint, if you borrow money at fixed rate, you pay 1% less than me. Yes or no? From your standpoint. From my standpoint, I pay 1% more than you. Okay, have this in mind, 1%. Now check the variable rate of interest or floating rate. What is the floating rate for you? It is SOFR, okay, SOFR, plus 2% for you, right?
Yes, sir.
If I borrow money at floating rate, what is the rate? SOFR, SOFR, plus
4%.
4%. Now tell me, if we borrow money at floating rate, you pay how much? You pay 2% less than me. Yes or no? You want to pay 2% less than me, right? And I'm paying what? 2% more than you. Got it? Now, think about this. So basically, what is good for you, for your company? Should you borrow money at a fixed rate or floating rate? If you borrow money at fixed rate, you pay only 1% less than me. But in case you borrow money at floating rate, how much you pay? You pay 2% less than me, right? Yes or no? Well, you pay SOFR plus 2, I pay SOFR plus 4. You pay 2% less than me, which is good actually for you. What is good for you is a floating rate. Why? You pay 2% less than me, right? What is good for you is actually floating rate. But what do you want? You want to go for a fixed rate because you want a certainty about the interest payment. Is that fine? So what is good for you is actually the floating rate. Got it? Now think from my standpoint. What is good for me? What is good for me? It is I pay 1% more than you in fixed rate. Yes or no? Whereas floating rate, I pay what? 2% more than you. You know what is good for me actually? What is good for me is what? Is a fixed rate because I pay only 1% more than you. Got it? Now, because here you see the difference. It is 2%. Even that should have been 1%. Had it been both 1% difference, then there is nothing called interest rate swap. It won't work. Okay, but it can work over here because there's a mispricing. You have to first understand something called the comparative advantage. Now, what is the net interest cost for each party? Is that question. Go to the solution, sir.
Yes, sir.
Yes, sir.
STPL 5.5% and TIMA SOFR.
No. I want the reasoning, the
Reason?
working note.
There
That
is
part.
bigger difference in the variable rate. So,
Hmm.
so to take advantage of this, TIMA will borrow fixed and STPL then has to borrow at a variable rate.
Oh.
Accordingly,
Ah,
swap arrangement shall be carried out as follows.
as follows. Yes, sir.
Working particulars TIMA STPL difference.
See, particulars, my company, your company, and the difference. Yes, sir.
Fixed TIMA 7%.
Tima, I can borrow money at 7% fixed rate. And you can borrow how much?
6.
At 6%. Therefore, what is the difference?
1%.
1% is the difference. Next.
Floating S plus 4%.
S is SOFR, okay, plus 4% for my company. Your company?
S plus 2%.
So what is the difference? 2%. There's a 1% difference in fixed rate. That minus the difference in the floating rate. What is the absolute difference? Ignoring the sign. 1 minus 2, how much? 1%, right? This 1% is a gain we can enjoy in case we decide to swap. Okay. Some people say swap, SWAP, or the right way to pronounce what? It's a swap. Okay. Yes, sir.
Split of gain equally.
Now, what is 1% divided by 2? It is 0.5% each. That means each of us can save 0.5%. Now tell me what is the rate of interest you want? You want a fixed rate, right?
Yes.
You want to pay fixed rate.
Yes.
Now what is your fixed rate normally? It is 6%, right? If you borrow money at fixed rate. But because you want to enjoy a 0.5% gain, what is 6 minus 0.5? You end up paying how much? 5.5%. Now, what about my company, Thema? I want a variable rate, right? Floating rate. Because I know in future the rate is going to decrease, right? I want a floating rate as per the question. I want to go for a floating rate. What is the normal floating rate? Yes plus 4%, right? So from 4 you subtract 0.5, I'm going to gain. What is the net amount? 3.5. Therefore, what is my net cost? Yes plus 3.5%. So these are the rates we will end up with. Very, very simple here. Find the gain and just check how the gain is shared between the two parties. And then you reduce it from now whatever rate they wish. You want to go for a fixed rate loan because you want some certainty in the interest payment, right? Therefore, you wanted 6%, but 6 minus 0.5, 5.5%. And I want a floating rate. So what is my floating rate generally? S plus 4. From my which option is that? It is option
A, sir.
Option A is the right answer. Okay. But don't bother. How does it work? The swap, that's so I can say first you have to borrow money at a variable rate, then you swap the loan. That's fine. But the point is, the effective cost is very simple. Your cost, you want to go for a fixed rate. Had you gone fixed rate, what is the normal rate? 6% applicable to you. But because your company is going to enjoy a 0.5% gain, your net cost will be 5.5%. And I want to go for, I means the TIMA, I want to go for a floating rate. My cost S plus 4% floating rate. On 4% cost, I want to enjoy a gain of 0.5 you subtract. What was my net cost? SOFR plus 3.5%. And S stands for SOFR. That is secured overnight funding rate. It is nothing but, in those days, we used to have something called the London Interbank Offer Rate. And that is gone. Okay. Now we have SOFR, Sonia, right? And so on. And also your Mumbai Interbank Offer Rate. Okay, guys? So that is an example on interest rate swap. Okay. Now next, I'll go to question number, okay? I'll go to question number, case study number 18. Case study number 18.
Yes, sir.
And we have the data. First, let us go through the data. And then there is a descriptive question. And this sum is really important. And anyone in the audience, appearing for AFM paper, do learn this sum really well. It will be useful even for your paper on AFM. Is that fine? Now let us go ahead and take on this question. Yes, sir.
Particulars, rupees in lakhs.
Now they given the data for the year gone by. He has given the data because later they'll ask you to value the business using something called the free cash flow to the firm approach. It's called the FF approach. Okay. Now let us read this data given. It's on page
206.
206. Guys, a very, very, very important question. This sum can be inserted in any case study. And they'll ask you to value the business. Yes, sir.
Property, plant and equipment employed 300 lakhs.
It's all rupees and lakhs, 300 lakh. Next.
Working capital 200 lakhs.
Working capital 200 lakh. That is example inventory. Okay, working capital investment. Next.
Equity 200 lakhs.
Equity 200 lakh. Okay.
9% debt 300 lakhs.
9% debt 300 lakh. Okay.
Corporate tax rate 30%.
Tax rate is 30%.
Risk-free rate of return 6%.
RF is given as 6%.
Asset beta of industry 0.6.
Here they given the asset beta, nothing but you can say that is unlevered beta, we say 0.6. Asset beta. That means you are supposed to calculate the beta equity depending on the debt equity mix. Okay. Next.
Market rate of return in the industry 10%.
The market rate of interest is 10%. Okay.
NOPAT for current year 200 lakhs.
The market rate of return rather is 10%. The RM is 10%. Okay, the RM. Next.
NOPAT for current year 200 lakhs.
That is a no PAT, nothing but the net operating profit after tax, right? How much?
200.
It is rupees 200 lakh given. Next.
Sales revenue for current year 1000 lakhs.
Sales revenue for the current year is rupees 1000 lakh. Then
the PP is being depreciated at the rate of 20% per annum.
it is given that the property, plant, equipment is depreciated at the rate of 20% per annum on the opening balance, right? What is
Yes,
it? 20%?
On per annum on opening balance.
On the opening balance. Remember, the 300 lakh is the closing balance for the current year, which will be the opening balance for the next year. Is that fine? Have that in mind. The PP. Next.
The sale revenue and net operating profit after tax would grow at the rate of 20% per annum.
Very clearly given the revenue and the NOPAT, both will increase at the rate of 20% for how many years?
Next 3 years.
Next 3 years, 20% increase. Current year is gone. That is like year 0. Leave. Next 3 years, year 1, 2, 3, the next 3 years, 20% year-on-year growth. Both revenue and NOPAT, both will grow at the rate of 20%. Thereafter,
sales revenue will be from 4th year onwards and increment.
The sales revenue will be stable, right? And then incremental, what is given?
And incremental capital expenditure will be offset
by capital. That's okay. Next.
Assets in brackets PPE and working capital turnover ratio shall remain constant and all over the years.
There are two ways of understanding this. What is working capital turnover ratio and property, plant, equipment turnover ratio? Generally, what happens? We divide sales by asset or sales by capital, by working capital. But instead, what you can do? Tell me, Chirag. Right now, what is sales for the current year? 1000 lakh given. And what is property, plant, equipment? 300 lakh. In case you want to find the fixed asset turnover ratio, it should be 1000 lakh sales divided by 300 lakh property plant. Should be around 3.33 times. Or you can also understand this way. What is 300 lakh divided by 1000 lakh? That means our property plant equipment is 30% of sales. Is that fine? Similarly, what is working capital currently is 200 lakh, right? What is 1000 lakh sales by 200 lakh working capital? It is 5 times. Or you can understand this way. Working capital is 200 lakh upon 1000 lakh sales means I can say working capital is maintained at 20% of turnover. Is that fine? You can understand that way. So that is a percentage of your fixed assets and current assets on sales to be maintained. Yes, sir. That's it.
Yes, sir.
Okay, that is the data given for you to value the business. Let's go to the question. What has been asked? Descriptive.
Question 7.
Question 7.
Determine the amount of bank finance available for expansion of operations of smartphones in accordance with proposal given by CFO.
How much loan you can borrow for funding this project? And they given estimates of all your cash flows, right? You can find out. Now let's go to the solution. And here you have to really work your backside off, guys. Okay. A real hard work. The reason is you have to estimate the free cash flows and you have to estimate something called the terminal value of the business end of year 3. Because from year 4, cash flow will be constant. And also you got to calculate the weighted average cost of capital so that will be used as a discount rate. And here one more thing, they haven't given the cost of equity. For that, I have to use a CAPM formula, RF plus beta equity into RM minus RF. Again, the beta equity is not given directly. You are supposed to estimate the beta equity using the beta asset. Okay. And this is a real challenge. Okay, this particular question. So here we go with the solution. Now, in this, before we can start the first chart, the table is given, right? Go to the solution, sir.
Yes, sir.
In that table, do you find the sales numbers? I need the sales numbers. Remember, 1000 lakh is the sales for the previous year. And it's given that sales will grow at 20% year on year for the first 3 years. Thereafter, stable, right? Yes, sir. Do you find sales?
Yes, sir.
Just see the sales number, guys. Everybody just watch, okay? Last year sales 1000 lakh. What is a 20% increase? It is 1200 lakh for year 1. And on that, once again, 20% increase and add it. It is 1440 lakh. Again, on that 20% increase, on 1440 plus 20% of 1440, how much? It is
728.
728.
28.
And what is for year 4? It is same
720.
720. Have they shown that?
Yes, sir.
Those are the sales figures for the years. Have this, okay? 1200 lakh, 1440, 1728, and 1728. Now, some people are saying, can I do this? So, can I take 1000 lakh into 1.2, 1 plus 0.2, 20%? Then take 1200 into 1.2, I get 1440. So, can I do 1440 into 1.2, I get 1728. And then 1728 remains constant from year 4 onwards, no change. 1728. Now I do this because remember I have to maintain a property, plant, equipment equal to how much? 30% of turnover. Yes or no? Remember 300 lakh last year upon 1000 lakh turnover. And what about the working capital? 200 lakh upon 1000 lakh, 20%. Is that fine? Now let us start. Let us first make this table to find how much you have to spend on fixed assets. I need all this data to calculate the free cash flows. Yes, sir. First chart.
Computation of bank finance available for expansion of
That's a
operations.
broad heading given. Okay. Under that.
Calculation of depreciation on assets, PPE and working capital rupees in lakhs.
Exactly. We want to first make a table for this. Okay. So particulars years 1, 2, 3, and 4 onwards. Yes, sir.
Opening balance of TPE,
Let's take a first year. Okay. We'll do for the first year. Opening balance how much? 300 lakh. Last year closing. And on that, what is 20% depreciation?
60.
60 lakh is subtract. What is the net amount? Is 240 lakh. Right? But how much you want to maintain closing balance? You want to maintain 30% of turnover. Now tell me what is 30% of 1,200? You want to maintain at least 360 lakh rupees worth of fixed assets at the year. Now how much you have at the after depreciation? Only 240 lakh you have. But how much you want to maintain? 360 lakh. That means how much you have to buy now? You have to buy 120 lakh worth of fixed assets. Have they shown that?
Yes, sir.
Purchase, how much?
120 lakhs.
So that 240 plus 120 is 360. In fact, 120 is supposed to be the plug. That is the balancing figure. You have 240 lakh worth of assets after depreciation, but you want to maintain rupees 360 lakh worth of fixed assets, which is nothing but 30% of that year's sales, 1,200, 360 you want to maintain. That means you have to spend 120 lakh, nothing but cash flow relating to investing activity as per accounting standard 3 or Ind AS 7 on statement of cash flows. It's capex. You have to spend 120 lakh on fixed assets in case you want to grow the business. Okay. So that is for year 1. Let us go to year 2, Chirag. What is the opening balance? 360. Last year's closing, right? On that, what is 20%? Is 72 lakh. Now, what is 360 minus 72? 288 lakh. But how much balance you want to maintain? At least 30% of 1,440, that year's turnover. How much? It is 432 you want to maintain. Now, what is 288 and 432 the difference? You have to buy how much?
44.
44 lakh worth of fixed assets. That is a capex, capital expenditure for the second year. Let's go to the third year. Third year, what is the opening balance?
432.
Very good. And then on that, what is 20% depreciation?
86.4.
I think after minusing, they haven't given the balance. Have they given the balance?
No, sir.
432 minus this one balance you'll get. Okay. And then what is the closing balance you want to maintain? It is 30% off 1728. How much? 518.
18.
The difference will be the purchase. I think they haven't shown amount after deficit, right? They haven't shown that.
Yes, sir.
You show that, it is easy for you to find the purchase. What is the purchase for the third year, sir? Capex.
172.8.
Very good. Let's go to the last year. Last year, what is the opening balance?
518.4.
And what is 20% on that depreciation?
103.68.
And then purchase, capex,
Purchase.
balancing figure, right? Balance, purchase, balancing figure. And what is the closing balance you want to maintain?
518.
No change. Same 518 you want. No more expansion. Therefore, the purchase will be equal to what? The depreciation figure. Yes or no? Yes?
Yes, sir.
Same 103.68.
68.
That's it. That's what they meant. Basically, you will, whatever you depreciate, that means some assets are going on value. To that extent, you'll purchase new assets. It's equal. Okay, that's it, done. That is for year 4 onward. And then next lines are working
Capital.
capital.
20% of sales.
You want to maintain 20%, right, of sales. Yes, sir. For the first year, how much you want to maintain?
Year 0, 200.
Last year, 200 lakh, right? And year 1, how much? 20% of 1,000?
200.
To how much? 240
40.
lakh you want to maintain. Year 2, how much?
1440.
On that 20%, how much?
288.
288. Next year, 1728, 20%, how much?
345.6.
And then next year, again 300.
45.6.
Okay. Now see how much increase in working capital each year. You already have 200 lakh end of year 0, right? But how much you want end of year 1? 240 lakh. What is the increase?
40.
That is an outflow. And you can take that 40 lakh information while calculating free cash flow. Have they shown that? No? 40 lakh increase? No. They are taken later, right? Okay. But have these numbers in your chart. So you will find what is the increase in working capital each year. And 240 has gone to how much by the second year?
280.
That means another 48 lakh outflow. You know what? Where do you do this? In accounting standard 3 or Ind AS 7, we do this to find the cash flow from operating activities. We subtract the increase in current assets. It's a cash outflow. Working capital changes. Okay, WCC. Now let us go ahead and now calculate the free cash flow to the firm. Yes, sir. Read.
Calculation of free cash flows from expansion of operations of smartphones.
Yes, sir.
Rupees in lakhs. Particulars, year 1, year 2, year 3, terminal value.
And terminal, because year 4 I need to find the terminal value at the end of year 3. That means what? In case you decide to sell the business end of year 3, how much will you get for the sale? Because if you sell the business end of year 3, the person who want to buy the business from you is looking at year 4 cash flow. But he will be looking at future economic benefits. Yes, sir.
No fact, year 1, 240.
240, last year 200 lakh. They are given 20% increase year on year. No bad. So 200 lakh plus 20%, 240. And 240 lakh plus 20%, 288. Again 20% increase, how much?
345.6.
And then the fourth year, same?
345.
Next.
Add depreciation.
Why is a non-cash item? Add back depreciation. How much?
Year 1,
It is 60 lakh, then 72 lakh, then
86.4 lakh.
and then
Nil.
okay, next.
Less
Last year they haven't added because anyway it's offset by your capex, right? If you want, you can add 103 and also subtract later capex 103. Yes or no? You can add depreciation for the fourth year, also subtract capex, okay? Or just ignore. Next.
Less increase in PPE.
Increase in PPE for year 1, how much?
120 lakhs.
Very good. Year 2,
144 lakhs.
144 purchase. And year 3,
172.8.
and year 4,
0.
why? Because if you added depreciation for the fourth year, 103 point something, you would have subtracted 103, right? In the adding and subtracting the same number, they ignored it. Next.
Less increase in working capital.
How much? 200 has gone to 240, 40 lakh increase, right?
Yes, sir.
And then 240 has gone to 288. How much? 48 lakh outflow. Next year, what is the outflow?
57.6.
And then thereafter?
0.
0, no increase. Next.
Free cash flows for firm.
Basically, from no PAT, you add back depreciation and minus a capital expenditure, also minus working capital investment. What is the net amount? Yes, sir.
Year 1, 140.
Very good.
Year 2, 168.
Okay.
Year 3, 201.6.
Okay.
Terminal year 345.6.
I will take the 345.6 lakh to find something called the terminal value of the business. Not now, okay? You want discounted directly. Then, after you finish off this table, next working.
Calculation of weighted average cost of capital.
Exactly. Now you need to find the back. For that, first I have to first find the cost of equity. For finding cost of equity, I need the beta equity. But they go in the beta asset. Yes, sir.
Equity beta is equals to asset beta into 1 plus debt equity ratio after tax.
Basically, that is nothing but that formula flows from. Okay. In fact, a similar sum is there in AFM also in the chapter business valuation. This formula flows from the formula given by very popular 2 authors. Okay. You would have done this at intermediate level in the chapter weighted average, something called the capital structure theories, two people, Franco Modigliani and Merton Miller. Okay, Nobel laureates. So it flows from that, this formula. Now you take the asset beta, that into what is that? 1 plus
Debt by
net equity after tax. Okay. Yes, sir.
beta A into 1 plus D by E into 1 minus T is equals to 0.6 into 1 plus 1.5 into 0.7, which is equal to 1.23. Cost of equity.
No, wait. Now first understand how they got 1.5 debt equity ratio. Remember in the question it was given, I think equity was some 200 lakh. And what is that? Debt of 300 lakh. Is that fine? What is the proportion? Totally 500 lakh. Equity and debt put together. Now what is debt? It is 300 lakh. Upon 500 lakh, it is 60% debt. And then what is 200 lakh by 500 lakh? Equity, 40% equity, right? If you divide a 60 by 40, debt by equity, you get 1.5. Is that fine? If you divide a 60 by 40, debt by equity, or can I do 300 lakh upon 200 lakh? You'll get 1.5. You can either take the amounts 300 lakh by 200 lakh, which is 1.5, or you can find the proportion and then divide 60% by 40%, 1.5. And you got the beta equity as 1 point. How much? 23, right? Yes, sir. Then
Cost of equity, RF plus beta E into RM minus RF.
so 6% plus
1.23
that into 10 minus 6. How much you get?
10.92%.
That is the cost of equity. Then
Cost of debt after tax.
I think they given 9% debt, right?
Is
What is the 9 into 1 minus 0.3?
6.3.
It is 6.3%. And now find the back. Yes, sir.
KD into WD plus KE into WE is equal to 6.3 into
It is 6.3 into
6.
nothing but you will say 300 lakh is the amount of debt. Upon 500 lakh funds employed. 300 plus 200 lakh equity. Or 60% debt, 0.6 plus
10.92 into
that into 0.4. How much you get?
8.148%.
This is supposed to be the weighted average cost of capital. I will use this as a discount rate for discounting my free cash flows. I want to find the discount factor using this discount rate, which is 8.148, right?
Yeah, 8.148.
148%. I'm going to use this as a discount rate to calculate the discounted cash flow. Yes, sir.
After that, calculation of total valuation of operations of smart.
Now we have come to the last step. Yes, sir.
Years 1, 2, 3 terminal, FCF rupees in lakhs, PVF at 8.148%, PV of FCF rupees in lakhs. Year 1, FCF 140 lakhs, PVF at 8.148%, 0.925.
0.925 is something you have to find out. 1 divided by 1 plus R. No, you know better. You would have done this at intermediate level capital budgeting chapter, investment decision, right? 1 by 1 plus R. So if I do 1 by 1 plus 0.08, I get the present value. And year 2, what is the number?
168.
To 0.855
and
then
140 into 0.791. Present value is equal to 159.46.
Then next.
Terminal 3.
How to find the terminal value? What I will do, I'll take the expected cash flow for the 4th year divided by back. And here anyway there's no growth rate. Otherwise, I'll denominator should be back minus growth rate. But here there's no growth rate. So divide the expected cash flow by back. I'll get the terminal value when? At the end of year 3. Remember, we take the 4th year cash flow to find the value of the business at the end of year 3. People ask me why. Think about it. We always say D1 by P naught. Remember that formula D1 by P naught plus G. That means what? Only if you know P naught, the price you paid today to enjoy the tomorrow's dividend. You guys are spending time today to enjoy the harvest after 3 months when you get your results. You have to invest today. So basically, in case you want to sell the business to someone, they will enjoy the 4th year cash flow only if they buy your business at the end of year 3. So this is a price at which you can sell your business to that person, the buyer. If you are a seller, somebody is going to buy your business. This is a terminal value, or we say the corporate residual value. This is a value at which you can sell your business to someone. It is nothing but the residual value of the corporation or the entity. Which is how much, sir? After dividing?
4241.53.
But that into the 3rd year factor,
791.
Exact, not the 4th year, 0.791. Then add up all the numbers in the last column, how much you get?
3787.656.
That is supposed to be the total value of the business. And of this value, we know 60% belongs to whom? Belongs to the debt holders, yes or no? You want, because you what is the proportion you want to maintain? 40% equity and 60% debt. Yes, sir.
Maximum bank finance available for expansion of operations of smartphone equals 60% of 3788 lakhs.
How much?
Which is equal to 2273 lakhs, or 60% of 3787.656 lakhs, which is equal to 2272.594 lakhs.
Rounding off. Okay. That's it?
Yes, sir.
So 60% you can borrow from the banker. This is the maximum loan you'll get. In case you have already some loan outstanding, then you can subtract that and balance is the amount you can borrow. Is that fine? Got it? And that is a maximum bank finance you can go for. 60% of the value of the business. Because you want to maintain a ratio of 60:40, debt equity ratio 60:40, right? There is a wonderful sum, guys. Learn this sum really well, just not for this paper. In case you are appearing for a group 1 as well, you have your AFM paper, learn this sum really well. This can come in your examination. And do focus on the asset beta concept really well. Something called the unlevered beta and levered beta. That point is there is some financial risk by, when the company employs debt. The reason is, in case a company goes into liquidation, what happens? The company will first pay whom? The debt holders, and only any balance will be given to whom? Will be given to the equity shareholders. That is why your Ind AS 32 will define an equity instrument. They will say an equity instrument is a contract. That is a proof that evidences a residual interest in the assets of an entity after deducting all liabilities. What a wonderful definition. What your +1 teacher would have taught you. Assets minus liability equals capital. That is the mean equity. Equity is nothing but the residual piece of any transaction is equity. You know that? The balance. You think about even your P&L statement. Sales minus all expenses and minus tax and minus any preference dividend. Any balance is a profits available to equity shareholders. Even if the company goes to liquidation, what happens? All assets are realized, minus all liabilities are paid off, and also minus the preference share capital, pay them off. Any balance will be available to the equity shareholders. That is why we say an equity instrument is a contract between the company and the holder gets only a residual interest in the assets of the entity. after minusing all the entities' liabilities. That is an equity instrument. Okay. So there's a very interesting definition. People should focus on that in day 32. That focus mainly whether to classify an instrument as a debt or equity, right? Very interesting. So let's now go ahead and take on the next question. I go ahead with question number 30. And then I'll take up one more example, 17. Okay, first we'll finish off 30. Very small question. Now let us read the data given, and then there are two MCQs, right? Yes, sir.
Following are the cash flows that are estimated over the life of the project. Year 1, 250 lakhs. Year 2, 600 lakhs. Year 3, 750 lakhs. Year 4, 800 lakhs. Year 5, 650 lakhs.
Okay.
Looking at the financial and taxation knowledge of...
No, that's okay. That's okay.
Yeah.
These are the cash flows given. An initial outlay for the project, the cost, year's cash flows. Then
Yes, sir.
that's it.
They have given looking at the financial and taxation knowledge of Mr. Karthik. Ms. Tina asked for a favor for him to help to calculate the deduction available to her under.
That's all okay. Oh no, let's go to the questions. No, let's see the questions asked. Yes, sir.
Yes, sir. The net present value of the project proposed for making investment based on risk-free approximately is.
Calculate the net present value of the project using the risk-free interest rate, right?
Yes, sir.
That is a question. Then what is the next question asked?
The net present value of the project for making investment on the basis of risk-adjusted discount.
Risk adjusted. Let's go to the risk adjusted discount rate. Yes, sir. Have you given that? Just search for the risk-free rate. I think the risk-free rate is given as, it's all scattered with information. Yes, sir. Read.
The investment of the said amount was to be made in a project associate company of WDG Limited. The risk-free rate of return is 7%.
It is 7% is a risk-free rate.
Risk premium expected by Mr. Karthik is 7%.
That means what? Since the project is risky, what is 7 plus 7? 14% is supposed to be the risk-adjusted discount rate. Yes, sir.
The life of the project is 5 years.
5-year life.
Yes, sir.
Now let us go ahead and take on the solution. Yes, sir. Answer to the first question. Don't read the option straight away. Read the working.
The present value of the cash flows for all the years by discounting the cash flow at 7%.
At 7% risk-free rate. Yes, sir.
Year 1 cash flow 250 lakhs. Discounting factor at 7%, 0.935.
Multiply and get the amount. Do that for year 2, year 3, year 4, and year 5. What is the total?
2443.4.
Okay, minus.
Less initial investment 1000 lakhs.
The initial outlay will be given in the question. Don't bother. Okay, 1000 lakh. You subtract and you get the net present value using what? A risk-free rate of interest. Remember, this method is suitable only when these cash flows are certain cash flows. It's called the certainty equivalent approach. What you study in advanced capital budgeting in AFM. Okay. But these are, unless these cash flows are certain cash flows, you cannot use a risk-free rate for discounting. But here we're doing it because the question says that calculate the net present value by discounting cash flows using the risk-free interest rate. And how much is it? So 1004?
43.4.
That's it. Which option is that?
B.
Okay. Then next. The second risk-adjusted discount rate, what you should do? 7% plus?
7.
14% is a discount rate. Now I discount the cash flows using a 14% discount rate and calculate the net present value. Yes, sir.
Total of present value of cash flows 1997.85. Less initial investment 1000 lakhs.
1000 lakh. And what is the net present value?
997.85.
And that is a net present value taking 7% plus 7% and all. 14% as a discount rate. or discounting the cash flows. Is that fine? Now, I don't know how far they want to make it so easy in the examination. Okay. And they will definitely, at least going by the trend, they are tightening the screw. Okay. So, some team like, Kenya or some team, you are up against, a team like Australia. You can never underestimate your opponent, right? You always prepare for that, black swan. அப்படின்னு சொல்லுவாங்க. I don't know whether you guys know this. There's something called the black swan event. Okay. Very interesting. It's something to do with finance. Okay. A black swan event is nothing but it has got three, features. A black swan event, Chirag, and the rest of the audience. Okay. A black swan event is a very rare event. What is that? It's a very rare event which has a significant or a great impact on your life or on the economy, whatever. And the third point is very interesting. These events are prospectively unpredictable, but retrospectively predictable. I'll give an example. Example, you take the First World War, or you take the Second World War. You take the Satyam scam, or you take the Great Depression 1929. All these events are rare events. It won't happen every year. Now, take the First World War. It's a very rare event. Okay. Number two, what has a great impact on people's life. And what is the third one? Prospectively unpredictable, retrospectively predictable. Okay, what is the meaning? Have you seen a history teacher? These are the causes for the First World War. Yes or no? She'll write that on the blackboard. If people knew those were the causes for the First World War, they could have what? They could have stopped it, right? So you will come to know the causes only after the First World War. That means when you look back, retrospectively what? Predictable, because these were the causes for the World War. But when you are going from 1913 onward, going towards the First World War, you never knew those were the causes. So that is the beauty or the real, the downside of a black swan event. It is a rare event, has a great impact, and most important, prospectively unpredictable, retrospectively predictable. This was even said by Steve Jobs. He said you can connect the dots backward. So after becoming a chartered accountant, you can say, I cleared CA because I did all this. These were the reasons I cleared CA. It is easy to connect the dots backward rather than what? Forward. The same thing is the third point. That's called the black swan event. Now let us go ahead and take on the next example. It is question number 17 from the case study number 17. Oh, what's the time by the way? We're not overshooting.
7:32.
Okay, thank you. So guys, question number 17.
Rate of basic custom
We have
duty.
Yeah.
Rate of basic customs duty on 2023 was 20%. On 21/8/2020.
No. I don't want that data. Now I want people to read this data where they given the spot exchange rate and then they given the interest rate in India and also the interest rate in the US, right? Read that data, sir.
Spot rates rupees 80.23 to rupees 80.98.
Dollar, right? Rupee to dollar.
Spot rates.
Now the spot rate, it is rupees to What is the other currency involved?
Rupees.
Okay, rupee, no, if rupee is agreed, it has to be against some other currency. Okay. It has to be the dollar, right? Rupee is how much? 80.98.
98.
Okay, then
Interest rate in India 10% per annum.
10% per annum in India.
Interest rate in US 4% per annum.
US is 4% per annum. Next.
That's it. Actual forward rates.
Then read further on. Actual forward
rates commensurate with theoretical forward rates.
It's given that the actual forward rate commensurate is going to match, okay, the theoretical forward rate using the IRPT, something called the interest rate parity theory. Then read further.
At the time of entering into forward contract, the bank charges a margin of 0.5% on
The bank will charge a 0.5% margin, right, when you enter into a forward contract. Then read further.
particular option. Strike price rupees 81.21.
Rupees and what? In dollars, right? There's one more column for dollars. Rupees 81 point how much?
21.
21. Then
0.0121.
that is given the strike price in dollar terms. Next.
Premium rupees 1.5.
Premium 1 rupee 50 paise.
50 cents.
Okay, next.
Particular outlet is located in a town with.
No, that's okay. Call option is given. That's it, right?
Yes, sir.
Now we shall go ahead and take on the. So have these numbers in mind. Okay, what are the numbers? What are the spot rates, sir?
80.98.
Hyphen?
80.23 hyphen 80.
Hyphen 80.98. Read that way. And then next.
Interest rate in India 10% per annum.
10% per annum and US?
4% per annum.
Very good. And then call option contract?
Strike price 81.21.
And then?
Premium rupees 1.
Oh, okay. All these are given, right? No, he's finding it difficult to read all this because a CA inter student. So, you have to give them cut in some slack. Okay, that means you have to be tolerant. So let's reach out cover. A company can go for a forward contract. That means please enter into a forward contract. Go to a banker and please book a forward contract so that you can buy those dollars or whatever required, okay, for payment. Is that fine? Next.
2 money market cover.
Go for a money market cover, that is money market hedge. Then.
And 3 currency option.
Currency options. Okay. So in this example, you have a payment to make. These are the 3 options available: forward contract, or go for a money market hedge, or what is that?
Currency option.
Currency options. Yes, sir.
Which of the alternatives is preferable by the company?
By the company. Okay. Go to the solution.
Yes, sir.
Buy dollar, that means the bank is going to sell the dollar to you, right? You need to buy dollars. That means what? A banker is going to sell. Therefore, the ask or the offer rate is relevant. Is that fine? Using that, you're supposed to put it by the banker is same as the theoretical forward rate. That means what? Using the interest rate parity theory. Okay? Yes, sir.
Hence, the relevant rate applicable for the company will be 3 months forward as INR.
And why 3 months? Because you have a payment in 3 months' time, as per the question. You have a payment in 3 months' time. So therefore, you define the forward rate taking the spot rate. What is spot rate? 80.98 relevant rate because you're going to buy dollars. Okay, 80.98. That into 1 plus, you take the rate of interest in India divided by 1 plus the rate of interest in US. In case you have doubt why rupee interest rate goes on top, dollar denominator, it flows from IRPT, or easy way to remember is, since the quote is rupee to dollar, is rupee per dollar, so rupee goes in the numerator divided by the dollar rate, the interest rate. Is that fine? Yes, sir. 80.98, that into 1 plus, and don't take 10%. 10% is for a year, right? What is for 3 months? It is a 2.5%, right? Yes, sir. 1 plus
0.025.
0.25, nothing but 2.5% in decimal format. Divided by 1 plus
0.01.
0.01. Nothing but what? They given 4% in US for 12 months. What is for 3 months? So 1%, which is 0.01. Okay, so how much you get?
Rupees 82.1826.
That is a forward rate, but don't stop here. Because you want to buy dollar, whenever you buy shares or something in stock, you have to pay what? Brokerage, right? Like that, to this you should add the margin, the brokerage. Yes, sir.
Since the bank charges 0.5% margin, total INR required for buying 1 USD will be rupees 82.5935, which is 82.1826 plus 82.5935.
And that is your outflow. For every dollar you buy, that is a cost in rupees. Suppose you want to buy $1 lakh, 1 lakh into this rate. That's it. Okay, that will be your rupee cost. And that is the final number. 82 point how much?
5935.
5935. Have this. Okay, circle this number. Okay. And call option contract. Totally get these two total. 81 point how much?
82.7.
Adding both, right?
Yeah.
Now, if you want, you can add one more number. Generally, we don't do that. But sometimes in your CA final settlement, they do add one more number. What is that? Interest on option premium. They assume that even to pay the option premium, your company borrowed money. Is that fine? Have you taken add interest?
Yes, sir.
On 1 rupee 50 paise, what is the rate of interest?
10%.
In India, 10% rate. They assume that you want to borrow money to pay the premium. But generally, we do not consider. We do consider, but I am not on the same page as they are. But anyway, always remember, you have to follow what is there in your study mat. Okay? And that's a logic. Fine. And here, I think they given both the answers. They given with interest and without interest, right?
Yes, sir.
So your cost can be 82.71 without interest. With interest, how much?
82.
This plus on 1 rupee 50 paise, 10% for 3 months. How much, sir?
0.037.
Add that total.
82.747.
That is your cost of purchasing each dollar in the market. Done. In case you go for a call option contract. Then comes the most interesting, what is that? The money market
Hedge.
hedge. Very simple. It is nothing but something called an asset liability matching concept. you have to create a foreign currency deposit investment, right? You have to invest the money in the US. Is that fine? Got it? Suppose you have a $1. You have a $1 payment. You better invest today some X number of dollars so that the amount you invest plus interest on that deposit for 3 months should be equal to $1. Is that fine? Because you have a liability, create an asset. Simple. How parents do. Suppose they have an obligation to educate the child. They want to send the child abroad for studies. They better start depositing money in the bank today so that this money will grow over the next 10, 15 years. That will match the obligation in 15 years' time. You need not invest that amount. You have to invest something less today. Anyway, the money will grow for the next 15 years. So that you have an asset to match your liability. The same logic applies. Yes, sir.
Money market action USD payable in 3 months. Invest now the present value of 1 USD equal to.
Suppose you have a $1 payment. Interest rate in US is 4%, right? Or 1% for 3 months, right?
Yes, sir.
So what are you going to do? $1 divided by 1.01. How much you get?
0.9901.
That means if you invest 0.99 blah blah dollars today at 4% rate in US, it'll become what? It'll become $1 in 3 months' time. It will become $1 in 3 months' time. Okay. So invest 0.99, how much? 0.99?
01.
Now tell me, if you want to create this dollar deposit today, you have to buy the dollars, right? What is the today's spot rate? 80 point.
90.
Into 80.98. That is a cost in rupees. Have you done that?
They have done 80.98 into 1 plus 0.5 percentage into USD 0.990.
80.98. That into
1 plus 0.05 into 0.9901.
So what do you do? They have done straight away. Okay, so what do you do? 80.98. Okay. And that into how much?
1 plus 0.05.
1 plus 0.05. Okay.
Into
What is that 0.05?
It is 5% return here.
They've done 5%. Don't do this. First, tell me how much you have to spend today. What is 80.98? 80.98. That into what is the rate? Into 0.99?
0.
That is the amount you have to spend today. How many rupees?
80.17.
That is the amount you have to spend. With us, that this money will be borrowed in India, okay, and repaid in how many months? 3 months. Have you shown that next?
Yeah, borrow rupees 80.
So that is the amount you have to repay in 3. Where you get the lowest cost. Is that fine? Got it? Now how much you get?
Summary of alternatives for borrowing. It's rupees 82.5.
Okay.
Since the cash outflow is lower in case of forward market hedge, it is preferable.
So forward is the lowest, right? The least the cost of the middle, right, of all the 3. Got it? Yes.
Yes, sir.
That are on in AFM. Okay. Now, one, you have to focus on forex. Please make a note if you want to. You focus on this. Go through the sums on forex. All right. Okay. And then number two, focus on mergers and acquisitions. Is that fine? Mergers and acquisitions. And then next, you have to focus on what is that? On valuation. These are three major topics: forex, mergers and acquisition, and then valuation. These are three major topics you have to focus on. Of course, you can also go through a bit of mutual funds and capital budget, advanced capital budget. So majorly they focus on mergers and then valuation and forex. Okay. And I don't know what are the books you generally carry to your examination. Open book. Okay. I, 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 I don't know. Whether that know how many books. So I don't know, but guys, but don't carry too many books. Okay, now too many books will spoil the dish. Even too many books will spoil you. Now carry what is required for the examination, and do not carry too many books. Notes, some handwritten, whatever is allowed. Make some notes. Make a proper index and go to the examination. Okay, and do prepare and go for this exam. And don't be very casual because anyway we have. I'm going to carry the books, so I will not go through what is there. It is better you go through your book and make a proper index and then go to the examination. And don't take it lightly. Okay. So prepare really well, guys. All the best. God bless you. Bye-bye.
Thank you so much, sir. Thank you for your valuable contribution. Thank you, my dear students. Tomorrow we can meet again. Bye-bye.